Yeah, this chapter focuses on what were the main reasons why the risk management fails and probably what is expected from the senior management, what is expected from the board of directors to make sure that the risk management activity is going into the deeper levels of the organization. So again, majorly talking about to start with the various steps that are involved in the risk management process, wherein we are talking about the risk assessment, where we have discussed yesterday in terms of you start with the identification, then we do some kind of evaluation wherein the focus is on finding out the probability as well as severity of the risk. Using these two, you compute the exposure of the risk and you prioritize the risk, and based on that come up with the risk management plan, wherein the major activity could be either risk retention or risk avoidance or risk mitigation or probably risk transfer like in insurance or derivatives kind of thing. And finally you are getting into the monitoring and updating of the risk. This is a typical risk management framework which was there as a part of the initial risk governance chapter, right? So when we so anything which we when we are looking at the risk assessment part, we are typically focusing on the evaluation and prioritization of the risk, and there is something relating with risk communication. How do you communicate the risk with the senior management and the various layers in the organization? And there is something to do with the monitoring on a regular basis. So come out with a policy framework which talks about how do you measure the risk, how do you monitor the risk, and finally the management, which is an integrated framework for the same. And here there are two ways of looking at it. One, you come out with some output measures. Generally every company puts some metrics in place, like something to do with the VAR. Okay, my VAR 1% daily VAR should not cross this particular number, or at any point in time the beta of the portfolio should not be more than something, or at any point in time the duration of the bond portfolio should not be more than this much. So they could come out with some solid numbers, quantitative data against which the limits can be set, and if the actual values are either above it or below it, again either the trading could be stopped or the size of the portfolio can be reduced, or some such kind of action items will typically come out of that mechanism. Now there is a very big misconception among the people that if there was a large loss that has occurred in a company, people think saying that the risk management has failed here. Risk management objective is not to remove risk, right? Probably we are going now in terms of, okay, as a risk manager you have to reduce the risk, blah blah blah, but it doesn't mean that you're acting as the role of a god where risk will never occur. That's not a typical risk manager's role. It's basically you are reducing the probability or impact, you are not making it zero. So if the large risk is occurring, again it has to be in the minds of the people that probably if the risk management was not implemented, the loss would have been even more severe, right? The risk manager has done some task in terms of reducing the intense. Probably the better example could be from the insurance world. Probably even after I take all kinds of care with respect to wearing seat belts and driving only at limited speed and all kinds of care, it doesn't mean that the risk will not occur. You are only reducing the though you say I have done very good risk management, I have put so much of protection to my car, so much of protection to myself, everything, and I am driving on a safe road, but still there is a possibility of the risk of accident coming up. So it doesn't mean that if a loss has occurred, risk management has failed. That is the biggest drawback in the risk management profession. Not only in this risk management, even when we look at, let's say, in a typical IT industry, testing is a job which is more in line with the risk management profession itself. Typically, in that software industry, a tester kind of a person is looked at as a kind of a villain in the company. Instead of looking at the person as identifier of the mistakes and probably the improvement in the process, it is directly looked at as someone who is who is trying to identify the mistakes of some other person. Probably it is looked at in the organization that the testers are the guys who are affecting the appraisals of the developers. So the same logic comes in here also. A risk manager, when he is putting lot of limits on the traders and all these things, it is perceived as, from the trader standpoint, it is perceived this guy is trying to obstruct our profit generating mechanisms. So any large loss, one big loss occurring, immediately fingers point towards the risk management profession itself. These guys have, though we are talking too much in and out of risk management, still we have lost. That's once a disaster occurs, probably this is what gets identified to, instead of understanding whether the risk management was proper or not. Because even if the risk management is fully in proper, there is a good chance that the risk can still occur. It's not making the risk as making the loss as zero at all. So as a good risk management process, at least what we can do is we can even come out with contingency plan. What if the risk occurs? Can I reduce? Can I get back to work very quickly? And that is what, from a bank standpoint, economic capital is doing. Right? If the loss does not occur at all, why should a bank maintain economic capital? If they have taken all mechanisms, let's assume they have taken all mechanisms to prevent a risk. What they could take, it's not that easy to completely zero down on the risk, which means they should not give loans, or probably they should deposit the money only in government securities. So there could be some mechanisms which they can follow where they take almost zero risk. But that way the bank cannot grow also. It's a compromise between growth and risk. So calculated risk taking is always there. Because of that, sometimes some large loss also can very much occur. The only good thing for a bank or any successful entity is, in case the risk occurs, do we have a proper backup? And that is where the economic capital is solving the purpose. Even if the bank loses this much because of a very big economic downfall, will the bank sustain without going bankrupt? So at least that much of capital is it there with the bank so that they can survive the next period. Otherwise, they have to go bankrupt and close down their operations altogether. So here, where all can the risk occur? It can start right from the measurement phase itself. Though Basel has introduced many mechanisms of measurement of credit risk, market risk, all kinds of risk, the measurement procedures itself will have big issues, because again it goes with the mathematicality and the statisticality that is associated with it. How do you identify what data is following what distribution? Because that's sometimes you may go with a very simple mechanism. Okay, the chance of occurrence is very high, the impact is very high. What is high? Can you quantify it in some dollars? So if I have to quantify the same number in dollars, probably there is a huge workout that is required in terms of understanding the patterns, distributions and all in the data. So the measurement is a very tedious process, right? Unless you identify the various distributions and all of that, the measurement of the numbers is going to be a tedious process. And especially when we are talking of interacting with two or more risk variables, identifying the correlations between them. It's not one time correlation. The correlation also will change with time. So predicting the correlations and identifying the impact of correlation is that these are all very challenging aspects. And in some cases, people generally go with subjectivity, high risk. So what is that high risk? Because at the end, we are talking of in dollars. Right? When I say the impact is high, the next question that comes up is how much can I lose? What would be the loss? Can you give me some number about it? So for those kind of things, the more and more accurately I am able to measure, and it's not that easy to measure accurately because we are not dealing with science, we are dealing with uncertainties. Science is more to do with a certainty, whereas we are dealing completely with an uncertainty kind of a world. So because of that, and even sometimes we may get some new peculiar distribution in the data also. Completely extreme kind of values can come out of the business execution. Because of all these things, measuring the risk accurately becomes a very critical process. And because we are not able to measure it, we will not be able to manage it, which will result in some kind of risk coming up. Though we have done our best in terms of doing some calculations and coming out with mitigation and contingency mechanism, still the risk can occur because of errors or because of inadequate knowledge or inadequate application in any one of these aspects. Apart from that, there could be issues at the recognition phase itself. What all risks? Right, for each single project there could be hundreds of risks that could be there. Typically, I was telling yesterday also, any assumption you make, it gets translated into a risk. See, when you are when you are using a CAPM formula, RI equal to RF plus beta times RM minus RF, there are so many assumptions under which that particular formula got derived. Right, every assumption is a risk. Let's say if it has assumed that unlimited short selling can be possible. Now, that's an assumption. What if that assumption is not there? Or what if the tax rates increase because CAPM has made an assumption that there are no taxes. So what if the taxes are there? What could be the kind of an impact if the taxes are present? And if the tax rate increases from 30% to 35%, what could be the kind of an impact? Because every assumption that is being made, it gets translated into a risk. Now, identifying all the risks would be a very tedious process from a company standpoint. So, sometimes there is a kind of implicity. Oh, this is already a known thing. Why do I need to identify it separately? It may be a known thing for you, implied kind of a requirement, right? Everyone makes this assumption, but probably the other party doesn't know that this is an assumption. So those kind of things wherein you don't identify all the risks and you don't incorporate, you don't analyze the severity and the probability of the occurrence of that risk, which is what could, and some new risk has completely come out and that has caused the disaster, which you were unable to visualize. That, like the Russian debt crisis, though the company has done so much of calculations and all, they could not visualize the government, that to an emerging market like Russian government, defaulting. Right? So those kind of things is because of those kind of things, though you have done all kinds of models and other exercises, the risk is still bound to occur. Then comes the communication part, wherein only some people are left to take the decisions. Instead of involvement across all the layers, if only senior management are getting into the decision making process without too much of inputs from the lower layers, because the typical culture for a proper risk management environment is it should come right from the entry level, because the lot of operation risks emerge from the entry level itself, the data entry related stuff, basic formula usage. Or senior managers don't get into those kind of aspects. So it's more and more, it's a culture that has to come right from the lower level. So regarding the risk, proper incentives have to drive the risk, right? Probably there should be a good linkage between incentives and risk management rather than profits and incentives. And also the communication of the results become the most, how timely the risks are identified earlier in the process and are communicated to the management forms one of the core aspects, and comes from the monitoring and the management dimension. Sometimes the market variables keep changing quite drastically. Let's say today the exchange rates are fluctuating quite drastically. Now, okay, if we see exchange rates are fluctuating, but is the GDP changing that heavily, or is the stock market changing that heavily compared to the exchange rates? Probably if you had looked at a few years back, the exchange rate and the stock market were positively correlated. Now what we are seeing is the exchange rate and the stock market are negatively correlated. For the last few days, we have been observing that the exchange rate is falling down, whereas the stock prices are going up. Whereas in some point in time, a few months back, we have seen that both of them are going in the same direction. And in the middle, when the exchange rate was mounting, the stock prices were falling. We had all kinds of scenarios, which means the correlation was changing with time. Only with one of the variable itself, when this kind of complex relation structure is there, we could very well visualize that the various securities can exhibit various kind of complex relationships with various macroeconomic and company related. So how quickly you are able to understand those patterns and change your investment decisions. So monitoring and reacting, right? If there is a failure at any of these places, even though you have implemented so many risk management processes in the company, they are typically bound to bounce back. So how quickly you are going to react? In case the risk is definitely occurring, what is the level of contingency plan that is existing? Probably that is where one concept from chemistry also comes into picture. The atomic world comes into a picture. There is a Heisenberg principle, probably in our 11th and 12th, it used to be there, which talks about if you are trying to increase the certainty of one variable, it will increase the uncertainty of other. It used to talk more about the certainty of finding an atom in one particular layer. It increases the uncertainty somewhere else. So which means you cannot increase the certainty across all the layers. So because of that, your prioritization in terms of where I have to concentrate more, which risk has to be reduced completely drastically, but at the same time, what could be the impact on the others? All these things have to be looked at, which means even though you have done all kinds of models and calculations and implementations and everything, it can still result in an occurrence of a loss. That is one thing which has to be understood. And even the people's psychology, as I said earlier, too much monitoring can even obstruct the innovations. Right? Whenever you keep complete limits, it could even obstruct the innovation, which means it's a kind of a culture that has to grow within the organization. Not few people directing it and few people ordering something. It has to be a kind of a culture that has to come up within the organization, and that is what will create a proper healthy risk management environment within the organization. And as we discussed, every company will have its own quantitative measures, right? Some probably there could be a VAR target, there could be a beta target, there could be duration target, some such kind of numbers for each of the risk measurement. They could very well be there. But sometimes by using those kind of numbers, what we'll see is we will see the targets take you operate in very narrow scope. The reason being, see, when I am saying VAR, let's say I have a VAR target. 1% daily VAR is equal to $10 million, which means the chance of daily loss going beyond $10 million should be only 1%. Probably if I expand it a little bit more, out of every 100 days, there should not be more than one day where my loss is more than $10 million. Right? Yes, fine. That is the target. Now, what is the way I can operate? Okay, every day $9 million loss. I'm still within my VAR target limit, because as per my VAR target, my daily loss out of every 100 days I take, not more than one day I should incur a loss of more than 10 million. Every day I'm incurring a loss of 9 million. So I'm within my VAR target, but see the overall loss, right? So when I'm dealing with more, probably to encounter that, there could be much more. Okay, I should have a weekly VAR limit, I should have a monthly VAR limit, I should have quarterly VAR limit, something like that. If I have, somewhere or the other that gets identified. But if I'm just going with one single limit, it is looking as if I am within control. But overall, if I see what is the volume of loss, so what typically these metrics, the quantitative metrics, what they do is they narrow down the scope in some cases quite drastically. Okay, I have met my target. But look at it on a broader picture, you have lost 9 million every day for the last 30 days. Still, it did not violate your VAR rule, because not even a single day you have crossed $10 million loss. So that is what it says. So 0 days exceeding the VAR, but overall big loss is possible. You did not exceed VAR on any single day, but still the overall loss was a very sizable thing. And VAR also we have already looked at earlier, value at risk. It does not talk about the size of the loss. It only talks about that particular cutoff point beyond which the probability is only 1% or 5% kind of numbers. So extreme, the what you call the shortfall. The shortfall risk was typically expected shortfall was another mechanism, which was a slight improvisation over value at risk, which was at least trying to capture the average risk beyond the VAR limit. Whereas VAR as such as a measure was not giving us that kind of a picture at all. So, and we have also identified that VAR had so many other limitations with respect to very extreme losses and all. It cannot identify any of them. And that too, VAR was primarily based on historical data. Right? We computed the mean, we computed the standard deviation, we said 2 standard deviations from the mean. So because of all those things, it was purely captured based on the historical data. And how much historical data I have to take was also not a known kind of stuff. It was also a kind of an uncertainty associated. And that too, when I am going with a portfolio VAR, right? One single security, if I want to compute the VAR, it's probably finding out the mean and the standard deviation. and probably finding out mean minus whatever 2 times standard deviation or something will give you your VAR. But when we are typically talking about portfolio VAR, we also have to incorporate the changing correlations with time. You have to forecast the correlations with respect to time, which means you have to bring out your chapter on estimating volatilities and correlations, and use the mechanisms like GARSH and EWMA kind of mechanisms to estimate the correlations over time, and based on that try to focus on your VAR. So portfolio VAR becomes more and more complicated because of the multi-dimensional measures that have to be measured in terms of covariances and correlations kind of stuff. So whenever you are thinking of one single metric, it will have all these kind of problems because the way you are computing them, the assumptions beyond assumptions based on which they are getting computed, all of them have to be really clear, because generally the quantitative metrics will narrow down the scope of the analysis. Basically people's mindset is also like this. Oh, they'll say, have I met the target? Over. So it will not broaden the scope in terms of thinking more deeper. So we have to be very careful when we have some quantitative, even in sales. Okay, if a typical thing, okay, per month you have to generate this much of volume of business. Yes, did I generate it? Over. But nothing more of analytics go into it in terms of what is the profile of the customers whom I am getting. Are they more and more repetitive in nature? Can I generate a constant business out of them? What is the kind of relationship I have maintained? Once I have met my target, it's over. That's a typical disadvantage that exists with most of the target based or metrics based kind of measurements, that they make the scope more and more narrow. We have to make sure that that scenario doesn't exist or doesn't come into picture.